So how was the non-farm payroll?
Yeah, I think it will be difficult for the Fed to bring down inflation with these numbers. So so what do you think?
I think that they trying to push the cryptos lower so they can buy them.
Well,
I mean,
where's Bitcoin standing? Oh, it's again 20,000. So I think we were below 20,000 today already.
Yeah,
right?
yeah, we are. Definitely we are. Okay, now they bounced a little bit with the non-farm payroll, but we went to 19,700, I mean, today. But I still, look, I'm still bearish on this. I still believe that there is easy room to go down to 18,000. Easy, at least to retrace a little bit. From the technical point of view, there is a nice head and shoulder on the daily chart, BTC USD. So I believe there is some room to move to the downside.
I hoped a little that we get to see a break above 25, and then we failed miserably and then dropped from there.
Okay.
So, but let's see. Probably that will come rather sooner than later. So, well.
Yeah.
Shall I share my screen, by the way?
Yes, please. Yes, please. The stage is yours.
So today, the focus will be on the non-farm payrolls. We won't talk about, well, probably we'll talk about Bitcoin. Why not? So I'm happy to be here today, and very interesting job data we just saw. And funny enough, you probably remember last month we had the NFPs, and it was around 511 or something like that. And then there was a question, well, where do these numbers come from? And in addition to that, will there be a revision lower, significantly lower? Well, no, there wasn't a revision lower. And in addition to that, also today we saw a surprise on the upside. If we combine this with the rhetoric being used from Fed Chairman Powell on Tuesday, in front of the US Congress at his semi-annual testimony, well, then it's getting more and more difficult, and I see more rate hikes to come. Interesting enough, based on the initial reaction, at least, we're pricing out now a little the 50 basis points, which market priced in for the March event, which will take place in around 2.5 weeks from now, on the 22nd of March. But still, I'm a little doubtful, to be honest. And numbers, well, numbers are good enough to push equities lower. If we get to see another spike higher here, and let's see. So initially we saw a pop higher. I think, let me just check here. Tesla. Not Tesla. Also US. I found so S&P 500. So slightly higher, above 3,900. But I'm not really sure, to be honest, if this is probably we will see another drive lower. I think it will mainly depend. There's another thing we should take into account today. There's a development in the banking sector. You probably have heard about Silicon Valley Financial, the bank. Sold out to 35 now in the pre-market. There was some strong buying against that level, by the way, and then we had news pending. I'm not really sure, by the way. Let me just check what happened there. Well, there's still news pending. So there's still news pending. So and there was massive buying against that level. So very interesting. In fact, could be that probably there will be some kind of relief, and that there's no further a need to be worried about the banking sector. Probably that's something to get to see. By the way, let me just check here. That could result then in a push higher, even though, again, so that could result in a push higher. Well, really, because if this problem is solved, then the chances of a more dovish stance from the Fed and jumping in for the rescue drops lower. So I'm getting ahead of a little of myself here. First of all, let's have a look at the risk disclaimer. You probably know, if you joined this event in the past, that we will cover the non-farm payrolls today. And it's not just that we will cover the event itself. but also we probably formulate trades based on my thoughts here. And that being said, if you take any positions based on that, please be aware that this is for educational purposes only. So I'm not giving you any kind of investment or trading advice here. If you take a position, if you like what I say, well, first of all, leave a thumb up here if you're watching this recording now on YouTube. Second, if you take a trade based on that, please be aware that you take full responsibility and that there's risk involved once you trade, especially leverage products as CFDs. And then that being said, please keep this in mind. If you take any positions based on that, again, it's purely educational. So I give you my thoughts on the Non-Farm Payrolls release. I will give you some thoughts what to make out of this and how to potentially draw a game plan, not just for equities, but also in addition to that, we will have a look at gold, for example, Euro USD, also probably if you're interested in Bitcoin. But again, purely educational content. I don't need to introduce admirals any further. I think this is due to the fact that Theo did an awesome job here already. So what we can do is jump straight into the action. In fact, respectively, it's not just jumping into the action, but in addition to that, we first of all wanna get a better overview of why the employment situation is of interest for us and why we look at this. So there is as you can see here, there's a chain, let's say, why employment numbers matter. Confidence in the economy, respectively, politics is good. That means that usually people are more optimistic for the future, and thus we see increasing orders in factories. So this is usually what you expect in a classic cycle, which means if you have increasing industrial production, well, companies will meet higher demand through more investments. If they meet higher demand through more investments, or if they try to achieve that, well, that means they need more workers doing that. We are looking here, by the way, that's very important to note. We are looking here at the manufacturing side. So we are not looking at the non-manufacturing side, services, internet companies, even though the idea behind this is very, very similar. If you have an environment in which you invest, respectively, if you have, let's say, an internet company, just use this as an example, and doing more advertisement, for example, and they will or have to run ads and build teams, market their products in the internet. Well, usually that will result where usually what you will see is an increase here in the spending, if especially liquidity is cheap, and thus you need more people doing the marketing, let's say, or advertisement on external websites, for example. But we are looking here at the manufacturing side. So very important to know that. So to meet higher demand, coming back to this, we need to hire more workers. And which means if you want to hire the best people, well, you have to compensate them accordingly. If you don't compensate them in a according fashion, they will join another company, which has also to meet higher demand for their products. And thus, what you will naturally see is that there's an increase in average hourly wages, and which means like people will have more money to spend. If you pay them more money, they have more money, and usually this will increase consumption, and there's a higher propensity to consume. That's equal to that. And that means higher economic growth. That means rising inflation. And that means central banks are motivated to raise interest rates to avoid an overheating of the economy. The current environment, things are a little different. So this is the classic picture here we're painting. Right now, inflation is getting or got out of control following the COVID pandemic and the massive stimulus we've seen, in this case from the Fed, but also here in Europe from the ECB, for example. They pumped massive liquidity into the system to avoid a complete collapse of the, in this case, US economy, but also in the Eurozone, for example, of the Euro economy. And why did they do that? Well, because there was COVID, there was lockdowns, they shut down the economy. The result was that there was no production taking place, so companies shut down. And then they were countering that by pumping in liquidity to keep especially people silent. People didn't really realize what was going on back then. And usually, well, there's a natural tendency towards, let's say, freedom. So people don't like to be put in prison or don't like to have to stay home. If it makes sense or not, well, today we know most likely it didn't, but however, you can keep them silent for at least a while by handing out stimulus checks, for example. Compensate them, you sell that way, you sell them the way that you say, well, we compensate you for staying home, and that you probably lost your jobs, even though we didn't really lose our jobs, because we also compensated companies for having to shut down, telling them, hey, you know what, guys, shut down the company, keep the people on your payroll. We know you don't have income right now because you can't sell anything to anyone because we just shut down everything. Therefore, keeping them on the payroll means we keep, for example, the employment or unemployment rates quite low, while we hand out stimulus checks or respectively money to you too. So long thing short, we put a lot of money here at work without producing anything, which will rather sooner or later result in rising inflation. And that's exactly what we got to see. And there was an explosion. Well, then we start to see some explanations why this was happening, and we're all completely surprised, especially the central bankers. They didn't see that coming. And then we have the war in Ukraine, and we have the invasion from Russia into the Ukraine. So then we start to sanction Russia. Then we put this in quotation marks, and we have rising costs for commodities, especially energy prices rise. And you now sell inflation as a result out of the sanctions to Russia, respectively, out of the invasion in the Ukraine from Russia. Even though we can, once we look at economic data, we will see that this rising inflation took already place way before, over the course of the year 2021, in fact. So it was quite a quick development which took place there. So long thing short, we have rising inflation. And now you need to counter that. How do you counter inflation? Well, produce more so that prices go down, or make sure that there's not more money flowing around. How do you do that? Well, by hiking interest rates. And this is exactly what we got to see over the course of the year 2022. And that's one of the main drivers lower for equity prices. So it's not necessarily what we currently see, and the rise in inflation, it's not necessarily due to economic growth. And there's several reasons to be very skeptical about this if the overall economic situation is strong. But let's put it another way. Given the employment numbers we just received, it seems at least as if, in this case, the US economy is quite stable. So it looks like, well, there is some kind of economic growth, which means if we don't bring inflation down right now, well, we have to keep interest rates higher. Usually the Fed will cut interest rates once there's an economic downturn and we are drifting into an economy. And right now there are several signs pointing in this direction. For example, there's a massive inversion of the 2- and 10-year yield curve, for example, which is usually a sign that short-term interest rates are expected to rise, but longer term, there's a drop in yields to be expected, given the fact that there will be a cool down of the economy. And right now, still, the Fed has to counter inflation by hiking rates aggressively. One example how to look at and where this idea of a recession comes from. But it's, let's say, kind of a weird recession. That doesn't make sense, because if you see such a strong development in the employment section, this is not a sign of a recession right now, which means the Fed is likelier to keep interest rates high to bring inflation back down. Respectively, it's probably motivated to hike them even further. So there was an interview, I think it was in 2022 in June, July, somewhere in summer, with Stanley Druckenmiller. He's a so-called market wizard, let's say. So he's a very successful fund manager, very successful trader, was also covered in the Market Wizard series with Jack Schwager. And he was, well, also one of the guys who broke the Bank of England in the early 90s, in fact. So he was trading with Soros' quantum fund back then. And there was, I think it was the head trader back then, and was massively betting against the Bank of England here. And that's exactly what we got to see. The Bank of England went down, and so long thing short, this guy knows what he's talking about, to put it differently. And during this interview, he said, well, in the past, once the inflation rate broke above the 5% threshold, if I'm not mistaken, the Fed only got it back under control if they hiked rates above the inflation rate. So right now we see kind of a stabilization. Let's see where we are headed here in inflation terms, CPI numbers next week. So that will be very, very interesting. I think numbers will be released on a Tuesday. I'm not really sure, but I think so. Check out the Forex calendar on admiralmarkets.com for I'm clearing this up. And so coming back to the current situation we see here. So right now, it's likely that the Fed will continue to hike rates, and or at least keep rates at the current level, which means then, looking now at the Fed watch tool, that right now the market is expecting a complete different picture than the market expected 1 month ago. 1 month ago, when we were here, well, we had a chart, the same chart, in fact, but with different columns. Back then, we had, let me just see, but probably I can, let me just see what will happen if I do that. There we go. So that last month, that was the chart we looked at last month. You can see here that the market was expecting, with a likelihood of 75%, 425 to 450 basis points by December 13th, 2023. That changed now. Let's come back here to today. Now, today, we are with a likelihood of nearly 60%, above 50% at 225 to 550. So 100 basis points higher than 1 month ago after the employment situation, and in combination with the comments from Fed Chairman Powell in front of the US Congress, even though that didn't really add much to the current speculation. What does this mean? Well, that means that the market, in this case, the futures market, is expecting the Fed to keep rates high and even higher than anticipated 1 month ago, to bring inflation back under control. So that being said, adds fire to the fuel, or adds fuel to the fire, that way around, in terms of what to expect in equity terms, because so far equity markets were capable of withstanding this rising pressure here. What do I mean by that? Let's head over to the chart. Let's have a look here. So this is gold. Let's have a look here at the NASDAQ, for example. So what we can see here is that the market, that was when the numbers were released 1 month ago. So that was here. That was the 3rd of February. The market came down, yes, because if you say, well, simply speaking, if you hike rates, usually that will result in a spike higher in yields, which will mean that equity prices will come under pressure. But compared to what we've seen here over the course, by the way, just go back, what we've seen over the course here of 2022, that was relatively strong. And in addition to that, by the way, there's also other reasons to be very, very, how can I say that? Skeptical, probably, if there is really risk aversion hitting, given the current environment. How do I measure that? Let me probably do something. I haven't prepared this, but I just, it just crosses my mind. So I want to enter XLP here. What is XLP? It's the Consumer Staples ETF. So like Walmart, or simply speaking, very easy and roughly speaking, it's like, this is the toilet paper indicator. So if you expect the economy to come down, you usually look for anti-cyclical investments, let's say. You're looking for stocks which will outperform the broader market, especially the risk appetite sector, let's say. So you don't expect the economy to grow, but in a recession, you expect the overall growth sector to underperform. but you still need toilet paper, let's put it simply. So which means like, well, usually you expect those consumer staples like Walmart to perform quite well. You can also check out the chart from Walmart, for example, when 2022 equities on a broad scale came under pressure, especially the tech sector made new yearly lows. Consumer staples pushed to new all-time highs. So which underlines my thesis here. And what we now do is we also add SMH here, which is the semiconductor ETF. So semiconductors, it's like NVIDIA, AMD. So and something, well, semis, for example, you need them in your smartphone. This is a sector which is very sensitive to yield developments, and it's also something noteworthy. You see this relatively strong once there is risk appetite. Probably a good way to put it. So now what we'll do is let's have a look here at the XLP, so let's call it the toilet paper ETF, and let's have a look here at the semiconductor. Sorry, the semiconductors. So how do I measure whether the market is relatively strong? I measure that by looking at these, broader market, or give you a broader idea of where we stand right now. What you can see is here, this is the semis. So we bottomed out, that was in October, and then from there pushed significantly higher. In fact, it's a plus 70% since then. And we are currently holding around here the August highs. So this is the SMH in this case, so semiconductor, while XLP, consumer staples, here's the August highs, is trading significantly below that. So how come, zooming out a little, so we are still holding significantly higher compared to especially the COVID lows, yes. But if you look at it from a shorter perspective, and if you look at it, for example, here from the October lows and the performance, you see that SMH so far is outperforming XLP, which means the market is buying risk assets. So it's looking for yield. It's looking for growth. So you don't see risk aversion here. And that being said, is an indication for me that right now the market is so far shrugging off these fears of rising yields. And so now coming back here to the Nasdaq, we're right now trading in a crucial area. Around here, you can see that this is the December highs, November, December highs around 12,000 points. And the question is now, can we hold this level or can't we? Looking now at the numbers, let's have a look here. So these are the numbers. I retweeted it from LiveSquawk. It's, by the way, a great source to follow on Twitter. And there you can see. So 311,000 compared to 225 expected. And previously, that's not right. 517, they revised it lower to 504, if I'm not mistaken, but still above 500,000. Unemployment rate 3.6 compared to 3.4%, which is interesting. So now we see an uptick, unemployment rate uptick, which is most likely resulting. You probably have also followed the news on this. There were massive layoffs from big tech companies, Amazon, Facebook, and so on and so forth. And so these layoffs, you can also see them in other sectors. You can also see many startups going out of business. This is exactly where the Silicon Valley bank developments right now coming into play, I think. So many startups weren't profitable, and right now they are running into liquidity issues. And most investors also taking out their money when it comes to investments in Silicon Valley Bank, where effectively taking out their deposits there, which is resulting in a liquidity crunch for them, because they see massive losses in terms of their bond holdings right now due to the rising inflation, rising yields, driven mainly by rising inflation, certainly, and the very restrictive course from the Fed in this context. So, and the funny thing is, so far in their balance sheet, there were floating losses, and we all knew this. If you read the statements in their balance carefully, you knew that they had trouble. But that wasn't realized losses. Why weren't that realized losses? Well, because they don't need to realize these losses, and they don't need to put them in their balance sheet, because they were bond holdings, and that's one reason. So how you count this, and now with this capital outflow out of Silicon Valley Bank, now they have to realize, because they have to liquidate these positions, and they become realized losses. It's not floating losses anymore, but realized losses, which is now resulting in a massive black hole, let's say, in their balance sheet. So that being said, means once the losses come to a point where the losses are higher than your overall equity, well, you're done. Okay, so you need someone to lend you money in this case, and there's only one lender of last resort, which is currently out of place. It's the Fed. So, and then you have the question, well, if this bank is going under, well, probably there's other smaller banks also following. But coming back, and this is where the unemployment rate comes into play. So we see an uptick here. So this is not a big surprise. And you see also, well, it's stable. Average hourly earnings, for example, quite stable numbers, but especially here, the non-farm payrolls, these are strong numbers. So it's not pointing towards that there's a massive cool down in the US economy, which is, by the way, let me just, I have to do 1 second, please. I have to write something down. Okay. So unemployment rate upticks, you see there. So right now, it looks like as if the Fed has more room to go on the upside, even though there's already we can see signs of the Fed potentially over tightening after this massive stimulus which took place following the COVID pandemic, given what we've currently witnessing in Silicon Valley Bank, for example. But still, again, coming back now to this quite solid job report, and then looking here at what we get to see right now in equities. So there's no sell-off right now taking place, but this could change. Well, especially today, because now you see that there's a bank which is on the brink of bankruptcy. We don't know yet. Let me just, by the way, check out here what happened so far. Still news pending, so still no news as far as I can see it here. Probably there's now a white knight coming out and saying, hey guys, you know what, we will rescue you, and thus there is no need for the Fed to step in here. But once this is not happening, and there's now this push lower, and given this solid job numbers report, market participants are expecting probably more of these banks, well, going bankrupt, respectively. There will be more tensions building, which could then spill over to the whole banking sector, which means now in front of the weekend, probably you will say, you know what, I'm probably pulling out my investment of now. Let's see what happens over the weekend. And then, well, let's see, let's take it from there. And this is massively adding to uncertainty right now, and potentially resulting in a flush lower here on the downside. So I wouldn't be surprised in case of the Nasdaq, but also in case of the DAX, for example. So depends a little on which index you're currently trading in this environment. But right now, I think, let's see whether we can hold here these, let's call them flush lows. Let's see whether we can hold 11,930 in terms of the Nasdaq. If we drop that level, if we drop below the levels from yesterday, around 11,900 points, if we hold below that, I think the Nasdaq is likely to go lower from here. It has at least room down to 11,800, probably even lower than that. Probably we have room down to 11,500, probably 600 into the weekly close. Could be deep red in this case. The similar situation right now happening here in the DAX. Let's look at a 50-minute chart. There's also here this level has been a support, or was a support. In the morning, it was a very interesting price action, I think. In the morning, we saw a flush lower. We held below 15,400, but then held the lows and push back above 15,400. So short here of the European equity markets was off the table. Then we have the numbers now. We see in immediately the flush lower. Why? Well, I just said it, because you see now speculations rising that the Fed will keep rates higher for a longer period of time due to the solid situation we find in the employment sector. So now the market is rolling over after holding quite strongly, in fact, initially, now rolling over. And if we drop here, this is around 15,370. Yeah, if we drop the lows, I think we also have in the DAX some serious trouble to be expected, especially since the DAX held quite nicely so far. But I don't think that the DAX really can withstand massive selling pressure from US equities if we get to see that. If we break here, in this case, so this is now a daily chart. If we break this trend line, I don't really see a reason why not to expect into the weekly close a push as low as 15,200, probably even a test of 15,000 into the next week then. Well, again, also the psychology playing a role here into the weekend. So market participants don't really know what to expect. Again, let me just check. Still news pending, still no news, which we get to see here. Let's see. Let's see how things play out here for SIVB in this case. This is, by the way, a stock. You can trade it. It's possible to trade it. You can see here via the symbol step, by the way. You can trade the stock. I'm sorry, SIVB. So this is here, SVB, so Silicon Valley Bank Financial Group. It's tradable, but I don't recommend doing that because you have news pending right now. This is a perfect example. There was huge buying, by the way, in the pre-market already against 35. You can see that in the chart if you look at the pre-market. And the problem is, I mean, you could easily formulate short setups, especially if we drop 35. I think then there's further room on the downside. But the problem is, you don't really know if liquidity providers here will run into trouble, halt the stock, if you're able to short it at all. In addition to, you should always be aware of the risk that there's now this white knight idea, which will result then in news pending. There was trading halt. You don't get out of your position. There's just you can't trade the stock anymore. Now trading halt is taking place around 1 hour, and then just imagine now the white knight comes out and you see a gap up. And then you have a circuit breaker. So you have another trading halt given the massive volatility to be expected. You can exit the position. So then you see a gap up, a gap up, a gap up. Based on that, probably back to, I don't know, $60, $70 or something like that. Still massively below the closing price from yesterday. By the way, the closing price on Wednesday was, I think, around 300 USD, if I'm not mistaken, 260, 270 or something like that. So long thing short, so you can get out of the position. The market is just jumping higher, which could result in massive losses. So I don't recommend trading SIVB today at all. If you're a gambler, well, go for it. Then this is the place to be for you. If you're a trader, and as a trader, we are risk managers first, and this is foremost what we should be interested in. Preserve our capital and manage our capital accordingly. Well, then this is not the place to be in this case. So we should look for liquid asset classes. In this case here now, especially indices seem to be interesting. Also based on the that looks interesting. Let's see if we drop again. If we drop the COVID lows. I'm sorry, the NFP lows here in this case as a trigger line, and we drop below the lows from yesterday and hold below. I think this is a clear sign of further weakness to be expected and further bearishness into the weekly close. Then, so that's around it, around the non-farm payrolls, and given the overall, the bigger picture in this case, so what's also of interest for us right now, and still, I think we should give especially gold a deeper look after the recent sellout, which happened, by the way. So gold is currently taking off. Now you might be surprised saying, hey, wait a second, you just said that yields are spiking higher. Isn't gold usually negatively correlated to spiking yields? Yes, this is true. But we have a very, very difficult environment right now with risk off hitting, because no one really knows what will happen to the US banking sector, which means risk aversion. Usually you head into so-called safe havens, which gold is, for example. right, or Tuesday, with the comments from Jay Powell in front of the US Congress, and during his semi-annual testimony here, we sold off massively, but potentially found a bottom around 1,800. Given right now the developments we're currently witnessing here in the overall market, but also given the strong jobs numbers here, usually you don't expect gold to perform extraordinarily bullish, but this is a sign of strength. And if we now take out here this, let's call it the bounce low, which we just formed shortly before this sell-off happened here, that's a sign of strength, and I think then we have plenty of room to go on the upside. Potentially 1,880, probably even 1,900 in the days to come, especially if risk aversion hits around the US banking sector in this context. And also market participants, and this is potentially a win-win for gold, if there's enough on the table, let's say, or if there's enough risk aversion hitting, and the banking sector is probably on the brink of disaster too, and headed for a crisis, then I think it won't take that long for the Fed to reverse course completely and say, well, guys, we have to save our banking sector first. And now we have to see, I mean, we find ways, but we are more willing to buy bonds probably back again. So another QE is on the table then, which is massively bullish here in this case for gold, but also something to keep in mind for Bitcoin, for example. Right now, Bitcoin is massively under pressure. So you can see that there. We failed around 25,000 on the upside. So that was a potential breakout level. We failed massively. And now rolling over, dropping a key level, I think here it's around, I think 21,000, 21,200 around. So this was a key level. We broke this. Right now we are under pressure because there's risk aversion in the market. If we get to see a bounce, let's see. This is a potential short trigger. If we can recapture 21,000, 21,500, I think we are potentially headed for another retest of the region. Well, probably, let's go more conservative, probably the region around 18,000 on the downside. But be very, very careful. Once this course is reversed, this very tight approach from the Fed, then we are potentially off the races and Bitcoin again, especially if we break above 25,000. But I'm not long. I'm not really willing to be long Bitcoin below 25,000. So this is definitely something to keep an eye on and be really, really, really careful about, I think. So that's it on, yeah, that's it on Bitcoin. Let me just check the chat box if there's any questions. No, not as of now. Let me just check here, by the way. Okay, that's interesting. Okay, that's really, really interesting what we get to see right now. So the DAX here, as you can see, the DAX is looking to test these lows, these extremes, and there's no real willingness to bounce here. So this is interesting. I mean, while right now we are within the first 10 minutes of Wall Street opening, so this is like, and we should be really careful to interpret too much into the price action. But given what we get to see right here, well, that doesn't look very promising, to be honest. So that's not positive at all. So any other assets we should have a look at? Probably let's have a look here at Euro USD. Also very interesting. This is, well, didn't expect that, to be honest. What do we get here? So US dollar under massive pressure. So if you ask me how to interpret this, because again, you have job numbers which are solid. You see right now gold heading higher, risk aversion. But why is the euro ripping? Because this is usually not something you expect here in this environment, right? Why is the euro ripping? I think market participants are already anticipating that the Fed has to reverse course. So I think this is like I'm putting a lot of pressure on the Fed and telling the Fed, well, guys, we see you want to fight inflation, but right now you let the banking sector collapse. So Sorry, but no, you won't let banks going down. So that being said, we expect you to intervene rather sooner than later, especially if we now put enough pressure on you, given also if there's enough pressure put on you, especially when looking at equity prices, for example, if there's now a sellout into the weekly close, which seems likely again. So the market is completely reversing the push higher here. Now we are attacking the lows from yesterday. There's no real bounce taking place. Let's see. First, again, we are within the first 50 minutes of trading of the day. So that doesn't mean that much. But if we drop the lows from yesterday and hold below, in case here of the NASDAQ, but it's a similar picture we get to see in S&P 500 that we have it. Very similar here. If we drop, let's see, it was, oh, we are already below that, by the way. So this was Asian markets. That was the Asian markets here. So we are below 3,900, below the NFP lows. That's if we hold lower here, there's further room on the downside, minimum down to 3,780, 3,800. So this is another 80, 90 points to go on the downside. And again, if there's now enough pressure building, and this is a spillover effect on other banks in this venture capital. So I think it's the tip of the iceberg, to be honest, because there was so much liquidity pumped into the system, and there was such a huge run. Let's have a look here. SIVB. Okay, so we are not trading it, but we look at the chart so that you get an overview of how much liquidity was pumped into the sector. So this is not Netflix, I'm sorry. Let's take this out. So, okay. So that was COVID, and that was the run which followed here, this banking sector. So there was huge landing, and there was a huge demand, and market participants said, well, as long as liquidity is cheap, this is a great business model, because there were lots of companies who were heading over to Silicon Valley Bank in this case, and asking for loans to fund their businesses, and there had lots of growth. Respectively, the outlook was very positive, and there was lots of money to be made for the bank itself, given the business model. And I think it was a 5-6-fold. I mean, this is a bank, okay? So it's like they make 5 to 6 times, 5 to 6-fold here, the share price, and then we collapse from November onwards, and now we're on the brink of bankruptcy. So that being said, and this is just one example, I think there's plenty of others out there. And even though, let's say, the banks in general, like a JP Morgan or Morgan Stanley, I mean, this is an investment bank, but still the big banks, well, they have a broader base, and they are not that affected by the current environment. Probably they can even profit from that if you give if you look at the earnings, the recent releases of the earnings, they were making good money on yields, at rising yields in this case, and compensating, on the other hand, for potential defaults which happened. So there was lots of defaults in the credit sector. It was just a question of time, in my opinion, once this hits. And now the question is, how worse, or how bad will things be, or how worse will it become till the Fed has to intervene? And so this is a crucial moment here. So by the way, so here, that was the closing price yesterday. Right now, in the pre-market, we are standing somewhere here. So that was like $30-$40 around the stock. And that being said, well, this is definitely something to keep an eye on, because this, well, again, tip of the iceberg. If this spills over to other banks, well, we definitely have trouble. In addition to that, we have a strong job market, which means like the Fed has no real chance, in fact, to be more dovish and to scale down, especially after the comments from Fed Chairman Powell. So that will be very interesting, because in 1.5 weeks from now, on the 22nd of March, we have the Fed. Let's see what the Fed delivers. So if the Fed comes out with especially a dot plot, which will be below what market participants expect, that could trigger a relief rally. But till then, we are likely to continue to see selling pressure, and especially today. So this is ugly now. This is ugly, and again, a clear short sign in my personal opinion, and has further room on the downside. So case here, if we drop in case of the Nasdaq 11,800, probably 11,500 today, realistic. On the downside, same is true for the DAX, also dropping here, as you can see here, now headed for the intraday lows. If we drop 300, well, most likely 200, probably even lower than that, probably probably even 1,500, probably 15,000. So that's definitely a target on the for the next week, depending a little on whether we break lower here, this trend line, and if we especially close below 15,200. So very exciting trading day. I have to jump into the action. I'm sorry. So I hope you enjoyed the webinar, and we'll see you again next week on Friday for the next Trading Spotlight webinar here together with Admirals. I wish you happy trading. Watch your stops, trade carefully, and be aware of the risks. And once you trade leverage products, don't take anything I just said as a financial advice, just as a idea of what currently is going on in the market. And talk to you again next week. So have a nice weekend. Enjoy yourself.